things that I learned is that our model compared to the credit card model is superior. I mean, the average outstanding balance for us on the consumer is $50 compared to $5,000 on the credit card. People pay back, they pay 25% upfront and they pay back within 43 days. We turn around our balance sheet 12 times. If I change my underwriting model, 50% of my balance sheet is underwritten according to the new model within 2 months. I mean, banks don't have that agility. Banks sit with, 70% of their balance sheet on longer than 3 years. So there is a very strong aspect to how our business model works, which is actually extremely recession-proof compared to the traditional credit cards. And also, as a consequence, more healthy for consumers because it is smaller amounts, lending on an installment, not on a revolving and not on high interest rate. And we're not encouraging you to push up a big credit card balance, to your point, which it has proven to be. And then finally, I would say one thing that I think is very critical is that we never borrow people cash, because we've seen that when you give people the ability to transfer balances, take out cash, it changes them. So underwriting on every purchase and being very mindful. And obviously, as we go into a recession, we do reevaluate our underwriting and kind of the risk that we want to take. But it is a model that has a very different strength to the ones. And I think that's why people like Apple are now embracing it, which I think is amazing.
Sebastian, 2 questions in one then. Having Apple come in as such a large player in the segment, is this designed to disrupt credit cards, do you think, overall? And number 2, do you have the right business model? Because Apple's is slightly different to yours, like some of the other rivals like Zilch, much closer to the customer, almost a line of credit for the customer, whereas you work much closer with the retailer and the merchant.
Well, I think of ourselves as a third-party network similar to Amex and PayPal. So we do think that the relationship with merchants matter because we can provide a lot of value to them. But we also do have, a direct relationship with the consumer, actually over 150 million consumers worldwide. But again, to me, what this is, I think it's amazing for the consumer. I think it's a final, massive embracement of what to me is a much healthier form of credit. Now, all forms of credit, obviously, as media and others have highlighted rightfully, comes with risks and needs to be mindfully applied and offered. But with that said, a fixed installment, a short-term lending at 0 interest for consumers is a better model. And I sincerely think we're going to be better off if 10 years from now, less people have credit cards, more people have debit cards, and occasionally use buy now, pay later services, which is the trend and the kind of direction that we're going.
You sound like a very nice man, Sebastian, but the fact of the matter is what you've said isn't quite accurate, is it? You've been around 17 years and your business isn't recession-proof. How much money did you make last year?
No, so that's correct. I mean, we were profitable until 2018, and then at that point of time, we saw a massive opportunity in the U.S. markets, and so we started investing, and we have been investing a lot of money into the U.S. market since then. So that's entirely accurate. So right now, obviously, with the sentiment in the market changing and investors being less interested in, just growth and wanting to see profitability, as you may have seen as well, we've announced, unfortunately, that we've taken a change and a shift in our own business as well. We had to unfortunately ask some of our fantastic employees, offer them packages, severance packages, and in order to prepare ourselves for a different environment.
Sebastian, you lost $748 million last year. You're cutting 10% of your workforce. You've got more competition in the market. It is a loss-making business with a shaky business model, isn't it?
I wouldn't say so. If you look at the 70% of our revenue that we do in Europe, it's actually running at a very healthy gross margins, a very profitable business, including the UK nowadays. So if you look at the overall big part of our business, then we have been investing heavily in the US, and now we're moving US towards profitability as well.
Sebastian, your credit losses were equivalent of 1.9% of consumer lending, which is a very low delinquency rate, and yet that ate up a third of your quarterly revenue as well. The business model in a tricky credit environment is going to absolutely be sived, isn't it? Again, I say a tricky credit environment, plus the fact there's more regulation coming as well, plus the fact there are more rivals coming. You've missed your chance to IPO, haven't you? Companies like Affirm that IPO, that got their IPO offer fallen dramatically, 65% in the last year. You've missed your opportunity, haven't you, sir?
Well, I think I'm looking into quite leading questions from your side, Mister. But if you look at that, no, I don't agree with you. Again, as I said, we take a new underwriting decision for every transaction, which is very different. So, as I said, if we change our underwriting model in just 2 months, 50% of the balance sheet is underwritten according to a new model. That's unheard of. You can't do that in a credit card business or any other type of bank. So it gives us a very strong recession-proof model. We have seen that in the UK as well. When we move from new customers are harder to underwrite, and as we move to more returning customers that we are familiar with, we do see a massive swing. And we've seen a massive amount of new customers coming on board in the US, which is what's driven those loss numbers that you quoted. And now we're seeing more and more returning customers, and we're less focused on getting new customers on board, which is what's costly for us since it's trickier to underwrite them.
Sebastian.
So, no, I think you're wrong, sir. There is actually a very strong recession-proof part of our model, and we feel very comfortable meeting this recession as we did in 2008 and previous years.